In the wake of 2 challenging years, marked by a rapid and significant deterioration of the operating environment, the credit quality of the sectors remains at risk, despite potential relief from interest rate cuts. The sector now faces multiple challenges: higher funding costs, declining valuations, and sluggish transaction markets that complicate debt reduction through disposals. Banks have tightened their grips on underwriting criteria, making refinancing more difficult, particularly for non-prime portfolios. The revival of investment market is crucial to address high leverage and upcoming refinancing needs. According to CBRE, and assuming current value and interest rates, the debt funding gap for commercial real estate loans originated from 2019 to 2022 and maturing over the next 3 years stands at 28%. Despite these obstacles, operating performance has remained solid, bolstered by indexation mechanisms and resilient occupancy. However, sentiment is shifting across countries and asset classes. We expect a stronger degree of divergence in credit quality between prime portfolios and their less prime counterparts. Rate cuts by central banks are expected to stimulate a rebound in real estate investment, leading to more transactions and gradually improving valuation, with a lower decline or even stable valuation in 2024. Over the past 2 years, investment volumes in Europe have dropped, falling by nearly 60% since the first quarter of 2022. The office and residential sectors experienced the most drastic decreases, with volumes down by 73% in both sectors. However, in the first quarter in 2024, the declines in volume slowed down 8% year-on-year compared to 57% drop of year prior. The slowing pace could signal a turning point. We expect a gradual recovery in transaction volume from the later half of 2024, driven by significantly unallocated capital targeting European CRE, and an uplift in investor sentiment as interest rates stabilize. CBRE anticipates a 10% average recovery across sectors and regions in investment volume for 2024. Still, compared to the last 15 years average, investment volume will remain relatively subdued. Lower interest rates will help restore the yield premium of real estate, and stabilizing funding costs should attract investors back to the market. The yield premium for European real estate investments took a significant hit in 2022 and has stayed below its 20 years average since. Nevertheless, the past price drops around 8% in 2023 across asset classes and geography, according to CBRE, should present more appealing investment opportunities and stimulate transactions. Healthier transaction markets will enhance issuers' ability to carry out disposals. With a larger pool of potential investors, price discovery will speed up. A recovery in transaction will support issuers' deleveraging effort, while reviving investor sentiment could gradually improve access to the equity market, which has been severely limited due to company trading at substantial discount to net asset value. Improved investment sentiment will also help issuers re-enter the unsecured bond market at more attractive spreads, allowing them to improve liquidity and reduce asset encumbrance. The downturn has varied by region, as will the recovery. UK valuation, with their earlier and steeper declines since 2022, have positioned the sector for a stronger recovery. Western Europe has been slower in its responses, as seen over previous cycles, with valuation expected to reverse late in 2024 or early 2025, a bit earlier than in the UK. Swiss valuations have seen modest declines, with robust fundamentals and investor appeal supporting the sector. We expect that the outlook for Swiss commercial real estate will improve in the later half of the year. In Central and Eastern Europe, valuations have remained relatively stable or even increasing slightly, thanks to higher yield pre-crisis, so that the valuation in these markets have been less susceptible to rising interest rates. And robust operational performance has also supported valuations. However, valuation dynamics extend beyond interest rate. The presence of forced sellers, for instance, can pressure valuation downwards in the market with larger funding gaps. While forced sales have been limited so far, we could see an increase as debt matures, because debt refinancing will be more complicated as banks have tightened their lending standards. Nordic markets, with shorter debt maturity and unresolved credit issues among some large issuers, are more vulnerable to forced sale. In terms of sectors, rental income will play a greater role in valuations, driving differentiation between property assets. We expect the logistics sector to recover first, with a turnaround in the first half of 2024. The low-yielding residential sector, most affected by interest rate hikes, will benefit from rate cuts. With solid rental growth due to the structural gap between housing demand and supply, we expect larger transactions as larger investors return to the market, albeit cautiously. We anticipate valuation improvement from late 2024 or early 2025. The retail sector has seen moderate decline since 2022, as prices had already been heavily impacted by the pandemic. Improving private consumption is a positive for the subsectors, and we forecast a gradual recovery for retail properties from late 2024 and early 2025, especially for dominant and convenience-led shopping centers. The office sector experienced significant declines driven by weaker economic activity and structural shifts like hybrid work environments and increased environmental scrutiny. We expect a stronger divergence between Grade A and Grade B offices, with Grade A office valuation set to recover by late 2024, as demand will remain robust and supply is limited. Concurrently, there is an increased need for investment to meet tenants' environmental and social requirements. The cost is unlikely to be offset by future rental growth in the Grade B portfolio, which will weigh further on their valuation. Carbon transition is increasingly under the spotlight. Buildings account for roughly 40% of Europe's energy consumption, and achieving carbon neutrality by 2050 will necessitate substantial investments in existing infrastructure. Asset obsolescence poses a growing threat. Legislation could limit the leasing of commercial properties with poor energy credentials by 2030, for instance. To avoid becoming stranded assets, it's critical to invest in meeting these standards. Physical risks are intensifying as climate events become more severe and frequent. These risks pose a credit concern because they could erode future margins and valuation, particularly for the portfolio concentrated in the most vulnerable regions. Social risks are rising, especially in the multifamily sector, where rent affordability issues are leading to stricter rental regulation due to social pressure. In the retail and office space, the future trends of remote work and e-commerce add to the uncertainty. Lastly, governance risks are prevalent. These often stem from concentrated ownership, cross-holdings, and joint ventures, which can complicate corporate structures and make some more susceptible to rapid shifts in business strategy or risk appetite. However, established financial policy and adherence to those, especially in the investment grade space, do counterbalance those risks.